Yes, I think Powell kind of set the stage last year at Jackson Hole by kind of, pointing out their shifting emphasis. So for the past 40 years or so, ever since Volcker raised rates and turned us from a structurally inflation to a disinflation period for 40 years, they've been kind of emphasizing inflation over unemployment, where they have two mandates that they balance, and they've been treating a 2% inflation target, especially in the past decade or so, more like a ceiling. Unemployment is in their view probably more important, especially when you go down into not just one employment figure, but employment among different demographics, employment among different income levels, wider measures of unemployment like underemployment, marginal employment, things like that, and that they're willing to let inflation run hot for periods of time in their view. Well, so prior to the meeting, we were seeing early signs that they were planning on, laying the foundations to get ready for tapering their asset purchases. And so, for example, they put in two standing repo facilities, even though at the moment there's no demand for repo. All the demand is for reverse repos, but they're still looking forward to putting those repo facilities in, which could prevent similar things to what happened back in 2019 when they were doing quantitative tightening. And so they're getting the foundation in place. And also, all this reverse repo activity kind of shows that there's too much, ironically, too much liquidity in the system, and it's spilling back over into the Fed anyway. And so they're getting all these signs that it's getting ready near time to start discussing tapering. And so the big question that a lot of people had going into Jackson Hole was, would Powell announce a specific date for tapering or not? Just because they're planning on tapering doesn't mean they're planning on raising rates anytime soon. And also kind of emphasize that if you look at broader employment measures, there's still pretty high levels of overall unemployment, low labor participation rate, and so he has a pretty high threshold for especially for raising rates, but even still remaining non-committal on asset tapering. And my base case is that he probably would not, especially with the whole Delta variant happening. The Jackson Hole event was moved virtual, and so far that's pretty much what we saw. Where they kind of did a good cop, bad cop routine, where a number of Fed officials came out pretty hawkish. Some of them had specific tapering dates that they'd like to see, generally starting, maybe later this year and then ending in the first half of next year. Whereas Powell himself came out a little bit on the dovish side, didn't yet commit to any tapering plan, discussed how interest rates are very disconnected from tapering. Yes, I think Powell kind of set the stage last year at Jackson Hole by kind of, pointing out their shifting emphasis. So for the past 40 years or so, ever since Volcker raised rates and turned us from a structurally inflation to a disinflation period for 40 years, they've been kind of emphasizing inflation over unemployment, where they have two mandates that they balance, and they've been treating a 2% inflation target, especially in the past decade or so, more like a ceiling. Going forward, they want to emphasize that unemployment is in their view probably more important, especially when you go down into not just one employment figure, but employment among different demographics, employment among different income levels, wider measures of unemployment like underemployment, marginal employment, things like that, and that they're willing to let inflation run hot for periods of time in their view. I also think that if you take a step back and look at history, where we are in the long-term debt cycle, many countries don't really have much of a choice other than to run kind of persistently negative real rates for at least their short-term treasuries, even their long-term treasuries, and that's the part that they can't really say out loud, too much. So instead, it's focusing on that unemployment figure. I think kind of emphasizing that more so than the inflation figure. And so right now they're buying $120 billion a month in assets. And it's important to keep in mind if they reduce that to 80 billion or 40 billion, they're still doing quantitative easing. They're still hyper dovish. They're just slightly less dovish than they are now. And so it's different than quantitative tightening or raising rates. So they're kind of discussing how dovish they want to be, whether or not, rather than saying that they want to switch to hawkish. So that still probably has a little while ahead of us. It took quite a bit after the previous crisis, and this might happen quicker, but it still will take some time. And to be clear, that was for the interest rate, so they can start tapering their rate of asset purchases before then. But he kind of insisted they would not raise rates until we've hit, in his view, maximum employment. And so I think, these basically one way or another, any companies need to start figuring out what is the future of money going to look like. Do they want to accept, say, Bitcoin payments, including over Lightning, for example, which are very efficient payment mechanisms? Do they want to accept stable coins? What do they want to know about central bank digital currencies? And so any large company really should, at this point, I think, have some crypto experts on staff so that executives know what's going on, or at least to, if they're smaller companies, to at least consult with firms that are really at the top of the industry. And so one way or another, we're clearly headed towards a digital future in terms of money. And so you have a variety of private assets like, say, Bitcoin or Ethereum. Then you have private stable coins like USDC, for example, Circle. Those more regulated types of coins. We've seen that Facebook has shown an interest in getting into the stablecoin market. So earlier it was Libra, then they faced some regulatory pushback. They kind of resurrected that as DM. We'll see where that goes. But clearly, stablecoin technology is very, very useful. And so that could have a large role to play in future payments. We also see various central banks around the world have kind of shifted towards researching central bank digital currencies. Some of them, like China, are far ahead of the curve. Other ones, like the Federal Reserve, are significantly far behind, and so they might be more willing to, say, partner with private, stablecoin issues and things like that. So it's certainly one of the options. I think if we were to see that, we'd probably see it more like say Square and Tesla, where they put a small percentage of their cash into that. I wouldn't be surprised to see it out of Facebook, for example. I think it'd be pretty rare, at least for a while, to see more companies do the MicroStrategy approach, where they put their entire balance sheet into Bitcoin. But certainly, companies with large cash positions, cash T-bills, they're finding themselves, inflation is higher than the interest rates that they're getting. And that environment could persist for quite a while. So it used to be that having a large cash position was an asset, but it's, increasingly a liability, a melting ice cube. Or they can also consider, blockchain technology itself. Now, the Amazon already has kind of, things like that. We have kind of a mostly centralized blockchain-like database where you can track changes. So, kind of the whole point of a blockchain is that it's a really inefficient database that happens to be decentralized. So you pay the price of efficiency in order to have it decentralized and therefore less vulnerable to corruption or other risks. And so, they can explore what that means for them, whether or not they want to get into the smart contract space. It could be very useful for insurance companies, as an example. Basically, writing things through code rather than human decision. And so there's a bunch of different factors they can look into. And then as you get larger and larger, as the space gets bigger and bigger, there are more people that do want to pay in cryptos. And it could literally, again, just be stable coins where you're still accepting dollars, but just in a different form. And so they have a lot of work to do, I think, to understand the full kind of spectrum of ways that space is relevant to them and their business, because they don't want to fall behind.